Hi everyone, so this video is going to very quickly take you through the basics of the circular flow model of the economy. We use this a lot in level 2 economics in particular, but it also comes up in level 3. And it's used to explain how money and resources flow around our economy and how each part of the economy is dependent on the others. So it's a very important idea of interdependence, that each part of the economy actually needs the other to grow and to operate. So here we go. All right, so this is the first part of the circular flow model of the economy. It looks a little bit complex, but don't worry too much about it. So we're starting off with these three parts of the economy. Households, that's us. Producers are businesses, obviously, and in the middle of all that is the government. So let's just start with households. So you'll see at the top here, households are considered to provide resources, or at the bottom, resources to producers. That's mainly labor. Okay, we go and work for producers in one form or another. In return, and we're actually missing the bottom flow there. In return, we get income. And income is a whole host of things. Oh, there is income. Income is a host of things, really important to remember. It's not just wages, it includes rent. It could include dividends, which is the share of profits from the producers. So it's not just wages and salaries as you'd tend to expect. So we provide resources, and in return, households get income from producers. You'll notice we've got a couple of different colors of flows on this graph. The black flows, goods and services and resources, are what we call real flows. They're flows of real things. Labor, like labor and so on, and goods and services. Whereas the green flows are money flows. Most of the flows, when we talk about the circular flow model of the economy, are money flows, but it's good to know about real flows as well. All right, so that's pretty much it. So households provide resources, in return we get income. At the top side, you'll see it's got a flow called consumption, or it should really be called consumption spending or consumer expenditure, anything like that, consumer spending. We spend money and we buy stuff from producers, goods and services. So that's pretty obvious, right? So there's money going from us, households, to producers. In return, they give us goods and services. Okay, very straightforward. So that's the most basic version of the circular flow model. In the middle of all that is the government. Okay, really important part of the economy, worth about 30% of everything that's produced in the economy is the government. And so we've got different flows here. So let's start over with the households and government flows. So we've got a flow coming out of households to the government called direct tax. So direct tax basically is income tax. We get paid income, but a chunk of that we have to pay to the government in the form of income tax. Really important to remember, because we don't then have that money to spend on goods and services because the government's got it. Directly paid to households, obviously only some households, is what we call transfer payments. You would probably know this better as benefits, right? So benefits are that we pay out a lot of money. The government pays a lot of money to households for benefits. There are a variety. They pay for people who are unemployed to continue to have some sort of income. They pay single parent families, generally speaking, will get some sort of benefit. We have a thing called working for families. Families who are working but who have kids get some sort of benefit. And important not to forget the pension, otherwise known as superannuation, which is paid by the government to any New Zealander over 65 years old. So all of those are transfer payments. So transfer payments obviously add to household income, but tax takes away from it. On the right-hand side here are flows from producers to the government. So let's start with the tax one, indirect tax. Don't worry too much about what indirect tax is, but it's GST. Producers collect that when they sell us stuff and then have to pay it to the government, and company tax. So when businesses make a profit, they need to pay a proportion of that to the government as well. So that's all indirect tax. And then on the vertical side is a really important one. Government spending. Don't worry too much about subsidies. Government spending. Government's buying goods and services. When they pay me, when they build the school, when they build roads, when they pay for Winston Peters or David Seymour to travel around the country, that is government spending. So that is a big chunk of the economy, like I said, about 30%. Subsidies are when the government pays businesses some sort of money to keep them going or to make things financially worthwhile for them. We have very few subsidies paid in New Zealand. There were big subsidies paid during COVID to businesses to keep them going, but generally speaking, there's not much at all that we do. Alrighty, so some key terms you need to know out of all that. I did go through these, but I'll repeat them. So income, wages, salaries, rent, dividends or profits, all coming from producers to households. Direct tax is income tax, whereas that goes from households to the government, whereas indirect tax is GST and company tax paid from businesses to the government. Transfer payments are benefits, all those different sorts you can think of. And government spending, the big G, is all the money spent on providing goods and services for the public. That's us. Notice it does not include benefits. They're two different flows for a reason. So government spending, you've got to get this in your head, is only spending on goods and services. That becomes important later on in the year. Alrighty. Then we're going to add in down the bottom here the financial sector. It's a really important part of the economy. They are, of course, a producer, but we separate them out because they have a sort of a different job to do. They collect savings from, particularly from households, also from businesses, but we mainly show it from households. In return, they take that money and lend it to businesses. And that flow you'll see there in the corner is called investment, and that is a really critical flow because investment has a very particular definition in economics, and this is one you just got to know, okay, whether you're level 2 or level 3. Investment in economics is when businesses buy capital goods. That's it. None of the, we're not buying shares, we're not putting money in a term deposit or anything like that. Investment in economics is businesses buying capital goods. So that flow there represents loans from the financial sector so that producers can do that. What are capital goods, you ask? Excellent question. Capital goods are any goods that are used by business to do their job. So it could be a computer, it could be a counter in their office, it could be a desk, it could be a pen, it could be chemicals that they're going to use in producing their product. Anything like that, those are all capital goods. Okay. You'll notice when you look at this as a simplified circular flow model, there are some flows missing. If households save money with banks or whatever, then banks pay them interest. That flow's not on there. If businesses borrow money from banks, then they need to pay them interest for the benefit. Households borrow money from the financial sector. There are a number of flows missing. This is the primary type of circular flow model that we stick with. So just to reiterate some of that, investment is when businesses buy capital goods, and capital goods are anything that helps the business do their job, produce their goods or services. All right, on to the last one. Right, here we go. I'm just going to see if I can move me out of the way of it. Here we go. All right, so the last sector, so 5 sectors. The last sector is the overseas sector. It's everybody outside of the country. Okay, so you'll see here we've got our export flows. Exports are goods we sell overseas. In return for that, the green flow is export receipts. Obviously, it's the money we get from overseas. It's in New Zealand's interest for the rest of the world to do well financially. Why? Because then they buy more of our stuff and we get more export receipts, which adds to our economy. In the bottom then, imports obviously are goods that we buy from overseas, and that really depends on how New Zealand is doing. If New Zealand is doing well, we buy more imports. If we're not doing so well, we buy less. So make sure you get that. And they're very separate. Exports depend on how the rest of the world's doing and whether they want to buy our stuff. Imports depends on how New Zealand is doing and whether we want to buy their stuff. Import payments obviously go out of the country to overseas. Okay, so we won't worry about some of the stuff down the bottom here, but so we have things that on the right hand side here, injections into the circular flow, things that increase our economy, our incomes, investment does that, more export receipts does that, more government spending does that. Things that would suck money out of the economy are taxes, obviously, import payments because the money is going overseas, and savings. Okay, they're not necessarily bad things because it depends on then what then happens with that money, but those are withdrawals from the economy. So what's the whole point of this circular flow model? It's to show all the connections between things and the flow-on effects. We're just going to look at a couple of examples for you. So the first one is something that's happened in the last year, in 2024, 2025, and that's this. What happens if the government cuts spending and makes a lot of public employees redundant, which is exactly what's happened under the current government. So you go back to your circular flow model. Well, obviously the government spending flow has been reduced. The flow from government to producers has gone down. So what? Well, okay, producers are going to be making less income. There's going to be a whole bunch of producers that were selling stuff to the government, not making as many sales. So what does that mean? They're going to need less resources, less workers, and so they're going to lay some people off or reduce their hours. And that's going to reduce the income flow to households. So incomes to households are going to go down. Also, producers are going to make less profit and they're going to pay less dividends. So the income flow will go down. If producers aren't doing so well, they'll pay less tax to the government. Okay, so that's a trail. So the government's going to they've cut their government spending, but they're going to get less tax from businesses, and they're going to get less tax from households if their households aren't working so much. So these are all interconnected. Okay, and you can go on. If households are earning less income, they're going to spend less, so consumption spending is going to go down, and so on. So everything is connected there. If households are getting less income, savings will go down as well. So it's a really good model if you're trying to write an answer about the effect of some sort of policy, to come back to this model and look at the flow-on effects and so on. Important not to get too carried away. If you are asked what's the effect of this policy, always start with the first flow that you can think of that's going to be affected. All right, another example. What happens if the world economy is having a good year? Growing incomes, confidence for the future is high. We wish. Certainly not the case in 2025. But suppose the world economy is doing really well. Well, that's actually a good thing for us. So there's going to be more demand for our exports, so our export flows is going to go up, and so export receipts will increase. So there'll be an increased flow of money coming from overseas to our producers. Great. No effect on imports necessarily, maybe, but the main effect is going to be on exports. What happens then? Well, the reverse of the previous example. Producers are going to need more workers, more resources of all sorts. They're going to therefore pay more income to households. They're going to make more profits as well. And that income is going to go to households. Households are going to spend more money. Consumption spending is going to increase. The government will receive more tax from producers because they're being more successful. And households, those ones who are working more hours or getting more jobs, are going to pay more tax to the government and so on. There should be less transfer payments. If unemployment's going down, they won't have to pay so much for unemployment. So they're all connected that way. If we can keep going with that, those producers who have been successful will need maybe to expand. The investment flow will increase as well. So all these things are connected. Okay, I hope all that makes sense. It's a general summary of the circular flow model and how we can connect all those dots and show how different sectors are interdependent.